in our next guest. He's Brian Belski. He's the Managing Director and Chief Investment Strategist over in Oppenheimer. He's the first to forecast the S&P hitting 1,300 this year. So, Brian, good to have you with us. So 1,300, so up about roughly 10% from where we are.
That's
right
okay,
now.
isn't it?
It is okay.
Not bad, especially considering we're already here in April, right?
Well, especially considering the day that we had last Friday, right? I think that this market year, 2010, is going to be a lot different than 2009, given the fact that fundamentals are now taking place. Plus, considering how much the market went up between March and December last year, you have a lot of shaky institutional money managers wanting to hang on to those gains and still feel good about what they're doing in terms of the fundamental direction of the market. So we're going to see reactionary trading like we did last Friday with respect to some of the news coming out on financials, and you've seen the market come right back again this week.
Well, let's talk about Friday. I mean, we did have a sell-off, but it wasn't terrible.
No.
And that's kind of interesting to see kind of the momentum. Everybody kind of wants to kind of push the market higher, ultimately.
Right. Well, I think there's a reason for that, Carol, and I think the reason is because fundamental condition of the market is very positive. We all seem to be wanting this blessed 10 or 15% correction, but the market's not giving us that because we think fundamentally the market looks very, very strong, and we are heading higher from here.
Well, you know, and you also point out that there aren't a lot of mom-and-pop investors in this stock market.
Right.
We hear from a lot of regular people on Main Street that they haven't ridden this rally up 80%. Do you sense that there's less panic in the market as a result?
I think there's less panic, but we really think that mom-and-pop are really the second round of investors that are going to come in. The first round of investors are those non-U.S. investors that are starting to feel some volatility, let's say in some currency trades around the world, maybe some economic trades in the emerging markets or China and other places where we've seen a lot more volatility relative to the U.S., and that's really been our call. I think we're going to see non-U.S. assets come back and buy U.S. equities, okay, buy our dollar, and then after this long period of positive performance, mom and pop in, let's say, Topeka, Kansas, can start to feel better about the equity market again.
But when you see mom and pop back in the market, you're going to run.
Well, not necessarily, because when mom and pop are at their kids' hockey game or soccer game telling everybody how much money they made on XYZ stock, that's when you want to run. Not just because the faucet's on, because equities are coming in. Keep in mind that everybody knows, it's been very well publicized, that equities have underperformed bonds for the last 10 years. Everybody knows that, right? We've seen so many things about international stocks, gold, commodities. Nobody wants to talk about U.S. stocks. So I believe now that we're underexposed U.S. stocks. So we need to see several months, if not years, of reinvesting in U.S. stocks before we're anywhere near any kind of euphoric type of range again.
Well, it's not just U.S. stocks, right? I mean, you point out the dollar as well, and we talk to Mike Arenstein all the time, who pointed out there was a total exodus of all U.S. linked assets, and people are starting to come back.
Right. The way that I like to explain it is in the 90s, things couldn't get any better here than it was, right? Stocks were going up, bonds were going up, the dollar was going up, the economy was going up. How much better was it going to get? Well, now, I mean, sorry, when the calendar turned year 2000, there was other alternatives. There was the euro, there was China, there was the breakdown in Eastern Europe, faster growth. So obviously there was a shift in terms of assets. Now, guess what? They're coming back.
Let me ask you, though, Brian, what about the issues out there, be it the deficit?
Right.
Still, you have a lot of states struggling. Obviously, you know, the federal government dealing with its deficit. You have other issues that, you know, more reform, more taxes. When does that kind of factor into your thinking?
Well, we'll say this. With respect to deficits and economies, markets are cyclical, economies are cyclical, politics are cyclical. We're learning that really quickly over the last 12 to 14 months. And guess what else is cyclical? Deficits. We will see all of these. But a deficit
of this size?
We will see it rebound. It may take several years. I may be sitting in a boat smoking a cigar in 50 years, but I think we're going to see a surplus in this country again. I really do. But keep in mind that 60% of the money, the stimulus money, is still sitting in the Federal Reserve.